What is the difference between exogenous and endogenous external shocks? Imagine a sudden storm hitting a calm lake. The ripples spread out unexpectedly, changing the water's surface instantly. In economics, similar surprises shake the economy, called external shocks. But not all shocks come from the same place. Some originate outside the economy, while others come from within. Understanding this difference helps us see how economies react and recover. Exogenous shocks are like that unexpected storm from outside the lake. They come from outside the economic system and are not caused by the economy itself. Think of a natural disaster like an earthquake or a hurricane. Or consider a sudden spike in oil prices caused by a political crisis in an oil-producing country. These events are unpredictable and happen outside the control of economic agents like consumers, businesses, or governments. Because they come from outside, they can cause big disruptions, affecting growth, inflation, and employment all at once. Endogenous shocks are different. They start from inside the economy itself. Imagine a financial crisis caused by a banking failure or a sudden drop in consumer confidence. These shocks happen because of the interactions within the economy. For example, if businesses suddenly cut back on investment because they see a slowdown, that can lead to a recession. Or if a government makes a policy mistake, like raising taxes too high, it can trigger a slowdown. These shocks are influenced by the decisions and behaviors of people and institutions within the system. The main difference is where the shock comes from and whether it can be controlled. Exogenous shocks are outside the economy and harder to prevent. Endogenous shocks are caused by the economy's own internal dynamics and can sometimes be managed or mitigated through policies. For example, governments can respond to an exogenous shock like a natural disaster with emergency aid or stimulus measures. But for endogenous shocks, policymakers might focus on fixing the underlying issues that cause the shock, like reforming financial regulations or adjusting interest rates. Sometimes the line between these two types of shocks blurs. A political event that seems external might have roots inside the social or political system. Still, in macroeconomics, we usually classify shocks based on whether they originate outside or inside the economic model. This classification helps economists understand what caused the fluctuations and how best to respond. When analyzing business cycles, economists use models to separate these shocks. They treat some variables, like weather or foreign policies, as exogenous because they are outside the system. Others, like consumer spending or investment, are endogenous because they respond to changes within the economy. Recognizing whether a shock is exogenous or endogenous helps in designing policies to stabilize the economy and promote growth. In the real world, exogenous shocks often requiring adaptation. Countries hit by natural disasters or sudden global price changes need to adjust quickly. Endogenous shocks, on the other hand, can sometimes be addressed by changing policies or regulations to prevent future problems. Knowing the source of a shock helps policymakers decide whether to focus on managing external risks or fixing internal weaknesses. This understanding is key to keeping economies stable and resilient over time.